Unearned what? What is unearned revenue? Why do companies like Spotify and Microsoft have unearned revenue? Why do people even like Taylor Swift record unearned revenue? Let's hit the definition for unearned revenue, figure out how we do the accounting, why we do it, and then hit some real world examples with Spotify and see how we account for unearned revenue. What is unearned revenue? That is a terrible name for what this actually is. If I could rename unearned revenue, redo the accounting, start from scratch, I would call it a cash advance or a prepayment. It makes more sense than unearned revenue, almost being an oxymoron. The definition here by the book is money received from customers for goods or services that have not yet been provided. So that might still not make any sense, right? But unearned revenue is when we receive cash for something that we sold or a service that we provided, but we haven't done our end of the bargain yet. We haven't done the work. So essentially, if you can remember this, unearned revenue is a liability at the end of the day. We owe someone something. We received cash first, but we still have to do the work. So we have a liability. It's not revenue until we've earned it. The big key thing with unearned revenue is the performance obligation, and that is the service or the good that's transferring to the customer. Whenever this performance obligation is satisfied, that is the moment that we can recognize the revenue. Before that, it's still got to be called unearned revenue. Let's hit our first example here with our favorite pop star, Taylor Swift. The Eras Tour is coming to your town, December 15th, 2024. You are extremely wealthy and you bought 2 tickets on January 15th, 2024 for $5,000. Now, my wife is a huge Taylor Swift fan. We did not get to go because we are broke. But in this example, you got to go, right? You bought 2 tickets on January 15th, a whole year before the concert, and you spent $5,000. What journal entry does T Swift make for your purchase in January? Key point is January. The journal entry is going to look like this. Taylor Swift's going to debit cash for $5,000 because she received money from you. And then she's going to credit unearned revenue for $5,000. This is not revenue yet. And why is that? Because of the performance obligation. The concert hasn't happened yet. You paid the money for Taylor Swift so that you can see a show. But she hasn't performed that show yet. It's still 12 months away. So until that show happens, until you go and have a great time and sing all the songs, all the doo-dah, it's unearned revenue. It's not been earned yet by Taylor Swift, so we credit unearned revenue, which is a liability account because Taylor Swift owes us something still. Great. Now it's December 15th. You went to the show. You had a splendid time with all the other Swifties. What journal entry does Taylor Swift record after the show has happened? So the performance obligation, the show that she put on, she did her part of the deal. She put on a show. She sang all your songs, had a good old dandy time. Now we're going to reverse the unearned revenue. It originally was credited, so now we're going to debit that for $5,000 to clear that out. And then our credit, you guessed it, is going to be revenue because she has earned that income now. She has earned the money that you paid before the show. And this is just an example of like 2 tickets, but essentially everyone that purchased tickets, it would all be pushed into revenue after the show is over because the performance obligation was satisfied. You paid cash, she puts on a show. Whenever those things meet, that's when we recognize the revenue. Key points. Always look for that performance obligation. When has that been satisfied? When has the service part of the deal occurred or been transferred, if it's a good, over to the customer? And timing. Guys, this is a big thing. It seems confusing that we even have to have unearned revenue, but it's because of accrual accounting. Not cruel accounting. It can be cruel at times, but accrual accounting cares about the matching principle. We care about when expenses were incurred and when revenue was earned, right? We don't care when cash was received. We care about when it was earned. And timing is such a big key part of this, and it's why we care about unearned revenue in the first place. All right, here's another example with Spotify. If you listen to them for music, or if you use Apple Music, another service provider like that, hopefully this really hits home. You purchased an annual subscription to Spotify on January 1st, 2024 for $120. What journal entry does Spotify record for your purchase on January 1st? They're going to record a debit to cash for $120, and then the credit is going to be to unearned revenue for $120. This isn't revenue yet because of the performance obligation. It still has to be satisfied. On January 1st, they received your money, but they haven't provided you any service yet. And this is a really good example of like contracts or software contracts. We'll see in our next journal entry, but we will slowly recognize this amount of revenue over the year as Spotify has earned it, because it's not quite as clear as going to a concert. That is a specific event, and you know exactly when it happened and when it was satisfied. So it's now January 31st, 1 month later after you paid $120. You've been jamming to your Spotify for a whole month now, listening to Drake and T Swift, and I don't know who's popular anymore because I'm becoming an old fart and I listen to 90s country. Anyways, what journal entry does Spotify record on January 31st? Now that there's been a month where you've used their service, they provided you with music. The journal entry looks like this. We're going to debit part of unearned revenue. Why $10? Because you paid $120 for the year, divided by 12 months is $10 per month. So each month, Spotify is going to recognize $10 of revenue. So we debit unearned revenue to decrease that account. And then we credit revenue for $10 because we've earned it. Now Spotify earned that money because they provided you service for 1 month. And then this journal entry would repeat in February, March, April, each month throughout the year as Spotify is providing the service. Because on January 1st, they haven't provided you with any services yet, so they can't recognize that revenue. Most companies will do this on a month-to-month basis. Now let's get into an example for the CPA exam. And so what I mean by this is this question's a little bit beefier, it's a little bit more challenging, something you're more likely to see on the exam. The last two are great examples for maybe accounting students in school, and if you're still trying to grasp the concept of unearned revenue. But this one is beefy. This is a good, challenging problem that'll help you prepare for the CPA exam. On January 1st, 2024, Microsoft sells a 1-year Office 365 software license to Thomas & Co. for $30,000, and also a maintenance agreement for $12,000. Microsoft will provide maintenance support or tech support to Thomas & Co. for 1 year. The accountant at Microsoft mistakenly recorded the total sales price of $42,000 to revenue on January 1st, 2024. The accountant realized the mistake on June 30th, 2024. What adjusting journal entry should the accountant make to correct this mistake? There's a lot going on in this problem, right? There's two different types of things that we're selling. And then not only are we not recording the initial entry, we are going to fix the mistake and make an adjusting entry. So let's start with the entry that the accountant made. They debited cash for $42,000 and credited everything, all $42,000, to revenue. But kind of like with the Spotify example that we saw, we can't recognize all the revenue from the service agreement, the service contract, because that performance obligation hasn't been satisfied yet. The service or maintenance is going to be performed throughout the year, so we have to recognize it slowly, similar to the Spotify example. So we should have recorded revenue of $30,000 for the software license. That can be recognized immediately because it's a product. They transferred ownership from them to us, and we can now use it at our leisure. But $12,000 should have gone to unearned revenue, and it didn't. It all went into revenue. So we need to fix that. But we need to check the date. We realized the mistake at June 30th. That's halfway through the year. So $12,000 should have gone into unearned revenue, but now it's halfway through the year, so half of $12,000 is $6,000. We've used up half of that agreement. Now Microsoft has earned $6,000 of that maintenance agreement, $1,000 per month for a total of $12,000. So our journal entry looks like this. We'll debit revenue for $6,000. And that might seem confusing, but it's because we need to take out $6,000 of revenue that was mistakenly recognized on January 1st. And then we're going to credit unearned revenue for $6,000. That's because we still need to recognize the last 6 months of the year, July through December. That income or that cash is not earned yet. We still need to recognize it as a liability because we owe maintenance services on that contract for 6 more months. So at the end of the day, this journal entry leaves you with $6,000 of revenue from the first half of the year, and then the last half of the year of $6,000 is still sitting in unearned revenue because we haven't satisfied that performance obligation. Microsoft hasn't provided those maintenance services yet. At the end of the year, or for each month throughout the rest of the year now, the accountant realized the mistake. They will debit unearned revenue for $1,000 and credit revenue for $1,000 each month to recognize that last $6,000 each month, one at a time. Unearned revenue can be super challenging, but hopefully these real world examples helps you get a better grasp of it for your accounting class or for the CPA exam. If you like this video, like the content, please give it a like, give the channel a subscribe, and please comment below if you want to see more content like this, or if you want to see more CPA exam material or more accounting material. Please give a comment below, share it, like, subscribe. Thank you so much.